Hey everyone, in today's video, I'm going to share with you a case study to demonstrate a key investing mistake that many long-term investors make. The company in question is Collins Foods, which is the biggest operator of KFC restaurants in Australia. And the stock has been on a terrific run over the past 5 years, gaining a total of 215% for a compounded return of 16%. And this should come as no surprise, because if you look at their core numbers, they've been able to grow their revenue, their earnings, their equity, and cash flows at a compounded rate of somewhere between 10 and 16% over the past 7 years. And when a stock goes on a run like this, there are many investors who are attracted towards it. So in today's video, I'm going to show you that despite the strong growth in their core numbers, this stock could be a dangerous investment. And no, this doesn't have anything to do with debt. There are plenty of videos that have been made recently covering the airlines or cruise companies. What I'm going to show you today is probably something that you have never seen before. But first, let me explain why the growth in those 4 key numbers is often such a good indication of a strong business. So as mentioned before, the 4 key numbers that we focus on are sales or revenue, earnings per share, equity, and free cash flow. And we use these numbers to assess whether a company has a distinct competitive advantage. And as a long-term investor, it is essential that the businesses that we invest in have a competitive advantage, or as Buffett would phrase it, a wide economic moat. And the reason why is that when we invest in businesses that have distinct competitive advantages, something unique over the competition, we can be confident that that business will continue to thrive and grow over the long term. And these numbers often do a pretty good job at telling us if a company has one, because if a business has a distinct advantage or they have something unique that the competition doesn't have, then they will be consistently attracting more customers or clients and therefore growing their sales, earnings, equity, and cash flows consistently and at a high rate. So that means that when we are analyzing a business as an investment, what we are looking for is the growth in these 4 key areas to be consistently above 10%, and in the best cases, the growth is accelerating over time. But sometimes these numbers can be misleading, and we're going to take a look at Collins Foods to demonstrate this. Collins operates a chain of KFC and Sizzler restaurants in Australia and Europe, but 80% of their operations is KFC Australia. And the growth of those 4 key areas is terrific, but what those 4 numbers do not tell us is how they are growing their revenue and profits. So to find this out for restaurant and retail companies, we can look to a number called the same store sales growth. And this number essentially shows us the growth in sales for existing restaurants. And that growth can essentially come from a couple of places. It can come from increased traffic, it can come from increased menu pricing, and then increases in the average order value per customer. And this for Collins Food has been very inconsistent and low, with an average of just 2% over the past 7 years for KFC Australia and much worse for their Sizzler operations. So you might now be wondering, how are they able to grow their overall company revenues at 12% per year if the growth in sales at their existing restaurants is only about 2%? Well, how they're doing it is that they are building more restaurants, which in of itself is not a bad thing at all. Of course, we want successful restaurant chains and successful retail stores to build more restaurants and capture more revenue. But when it is bad, is when the existing restaurants or retail stores are very weak and are losing customers over time or just not growing substantially over time. Because a true competitive advantage in the restaurant industry or in the retail industry would be shown by consistently strong same-store sales growth of something like 5% or higher. And why is that? Well, because if you think about it logically, what would be showing us that customers are consistently coming back and loving to dine in at that restaurant, enjoying the food, enjoying the service? Well, it would be an increase in traffic and it would be an increase in the average order value. And those 2 things are shown in the same store sales growth. So a restaurant like Collins Foods is able to grow at a high rate by building more restaurants, but that does not mean that they have a competitive advantage, because if we look at the growth of their existing restaurants, it's showing us that there is not consistently a high number of people coming back and dining at these KFC restaurants. So what does that mean for Collins Food? Because clearly, even though their KFC restaurants, their existing KFC restaurants have not been performing that well, they've clearly been able to grow their business substantially over the past 5 years, and they've been able to grow value for shareholders and grow the stock price. So what's next for Collins Foods? Well, I think that they can probably continue to do this strategy of just building more restaurants and growing by expanding, probably for a number of more years. And you're very welcome to sort of gamble on how long that is going to last. But when the opportunity to continue to expand the number of restaurants is limited, then what is going to be left for growth for this company? It will be that very, very slow comparable sales growth or same-store sales growth, which means that growth is going to go from being in mid double digits all the way down to somewhere around 2 to 5%. And when that happens, I guarantee you that the stock is going to get killed. So it's a case of a business that, is running a model that might work for the next few years. But if you're a long-term investor, if you're looking for a business to hold for a decade, or in the best case scenario, you want to hold it for the rest of your life, then you want to find, in this example, a restaurant that people are consistently coming back, they're telling their friends and family, and you're seeing that their same-store sales growth is consistently going up at a high rate, so that even if the company was no longer able to expand, they would still see growth in their sales, in their profits, and you as a shareholder would benefit from that over the long term. So I hope you guys enjoyed today's video, and if you want to see more case studies like this where I dive deep into one section of the stock analysis process and use a real company as an example, then make sure you leave a like on the video, and of course let me know your thoughts down in the comment section as always. And if you're new around here, of course, hit subscribe, join the team so that you can stay up to date with all of the latest videos. But other than that, I hope you guys have a great day, and I'll see you in the next video.